Hello traders, Ben McInerney here from spotonforex.com. This is a very quick complimentary video for an article I've written for Forex Alchemy. It's on backtesting. If you have not read the article yet, you're best looking at that first, otherwise this won't make a lot of sense. So just click on the link below this video to get there. Now this is on backtesting. And I just wanted to give you a quick example of how to carry out backtesting in MT4. This is where I do all my testing. So we have a MT4 chart. We're on the Euro US dollar 1 hour. Now, as I mentioned, you can do this for absolutely anything. Any single price behavior, strategy that you might have, everything and anything you can test in this fashion. So the example I wanted to give you here was a strategy that I play every day, which is the Asian range trade. This indicator here, so you have your vertical lines, which is your separating your days, and these green boxes is the Asian range, and obviously the support and resistance lines has boxed off that Asian range. So when I initially started to want to form a trade based around the Asian range, I was looking at a few different things. First, I actually was looking to do what everyone else does with the Asian range and trade a breakout type system. But I noticed that when I was just flicking through my charts like this, that the price tends to exit the Asian range and travel to the other side of it quite often. You can see here the price seems to travel right through the Asian range quite often. So firstly, your first initial couple of passes when you're backtesting is you want a year's worth of data as a minimum, so 365 days, depending on obviously the time frame you're using. If it's a 5-minute time frame, you could probably get away with less. So just here I've taken back to July 29th, 2003. So my initial pass, I'm just observing whether this is actually going to be a trade or something that I want to look at in a little more detail. So I made my initial pass. I did discover that the price had crossed through the Asian range quite often. So I thought, okay, I do want to test some parts of this. So when I've decided firstly what I want to test, so I'm on the hourly chart here. Let's say I want to test in the hourly chart how often it occurs in a 12-month period. So that would be my first test. So again, you can do that just by flicking through the charts, and you'd obviously count the number of times it crosses, once, twice. We've got 1, 2, 3. Here we've got 1, 2. And you'd obviously mark the occurrence, and then the next time around you'd probably get an idea of the type of parameters that you want to trade around. So you start to build your risk model and your strategy. So what I do is if you press F12, you'll notice the chart, you can click through one bar at a time, and that doesn't matter what time frame you're on. If I drop to the 15-minute chart, I can still just click through one at a time. So as prices popped out, I can quite quickly go to the next day. Okay, prices cross through, so I'll mark that. Or I could have had, well, once price crosses the line here, so once it pierces out and comes back in, once it crosses the line, for example, I could take a trade with a 10-pip stop. So this first one would have been recorded as a loss. I set another one, and this second one would be recorded as a win because it hasn't stopped me out and it's gone through. Now you can just, I suggest you just record them as wins or losses to start with until you start refining it right down. Then you can look at exact pip values. On your screen now is an example of exactly how I record. When I was recording different statistics from my Asian range trade, I had a specific objective, so time spent out of Asian range, so a whole candlestick of session spent out of Asian range, so a full exit, and I was testing whether a shallow exit or a larger exit or a full exit yielded different results. So here we have different variables that you can test, even if you were just testing pin bars, for example. So these are the some of the variables you can test. The volatility, the currency pair always makes a big difference. Each currency pair has a different personality. So you can trade those different traits and get familiar with certain currency pairs. Obviously, varying types of price action, fundamental support and resistance. There's some confluencing factors you can use to build on your trading system. You can add pivots, Fibonacci, average true range, and there's a whole range of things that you can add. So as you go through these various exercises and your sample size begins to grow, your knowledge of the specific price behaviors and your personal psychology as far as that particular trading system begins to grow also. Your risk model and your trading model becomes refined, which in turn reduces your risk, and obviously the accuracy of your strategy is improved. So if we pick, say, just one of these examples, such as time of day, we can then test different variables within time of day. We can look at exactly what price is doing in relation to our strategy on London Open, for example, London close, the Asian session, the New York close. So each time you go back and you do back test, it's got to be objective-based structured testing. So you need an objective each time you test. I do suggest you only test one thing at a time. Don't try and test 3 or 4 things. It only becomes confusing. But over a large enough sample size, you will build a positive expectancy trading system that suits your own unique trading psychology and risk appetite. And this is the most important thing.